Options may sound intimidating, but by the end of this video, I'm going to explain to you the basics, everything you need to know. So my name's Alex. I started my career as a quantitative trader at Susquehanna International Group, which is one of the most successful, prop trading firms, and I was an options trader. So for whatever reason you're watching this video, maybe you want to trade options on your own in your Fidelity account. Maybe you want a job at an investment bank like Goldman Sachs or Morgan Stanley as an options trader, or maybe you're just in a finance class. I'm going to teach you everything you need to know about options. The two main types of options are calls and puts, but I'm also going to explain to you risks of trading options, pitfalls for beginners when they start trading options. So let's start out with the basics. What is an option? An option is the right, but not the obligation to buy or sell a security by a certain amount of time. So, which is called the expiration date. So for example, a call option lets you buy, let's say, a stock at a particular price by a particular date. So I'll give you a simple example. Is currently Apple stock is trading at $258. If I'm really bullish Apple this week, I think the price is going to go way up. I could just buy Apple stock, but then I have to commit $258. Whereas I could just buy a call option, which is essentially taking a bet on the stock to go up. So let's say, for example, I buy a call option with the expiration date being the end of the week and a strike price of $290. So what this means is anytime within the week before the expiration on Friday, I can buy Apple stock at $290. Obviously, if Apple stock is $280 at the end of the week, I'm not going to exercise the option, or I'm not going to use the option. Essentially, I bought something that's worthless, right? If Apple let's say on Friday, is trading at $280, I'm not going to exercise my option to buy Apple at $290 because it doesn't make any sense. I could just go into the stock market and buy Apple at $280. So my option was worthless, right? However, let's say I'm right and Apple has a crazy product launch and the price of Apple spikes to $350. Then what I could do is I could exercise my option, buy Apple stock for $290. So I just bought something at $290 that's trading in the market at $350. So I could buy the stock and then I could even just sell it in the market. I could buy the stock at $290 and then flip it, sell it right away in the market at $350 to bank $60 in profit. Or once the stock starts ripping, you can just sell the option once again in the options market. You can just sell your option for a big profit. So with options, your bet is completely customizable. So the price where you want the right to buy a stock is called the strike price. So buying an Apple call option at a $280 strike price versus a $290 strike price versus a $300 strike price is different. Because let's say I buy a call option where the strike price is $290 and Apple is at $295. Well, here, my option's actually worth something, right? I can buy the stock, I can buy Apple at $290 and sell it at $295. I'm making a profit. However, if the strike price were $300, my option would be worthless by the end of the week. I'm not going to buy Apple at $300 when it's trading in the market at $295, and I could just go into the stock market and buy it for $295. So essentially, options are fully customizable. You can also customize the date, right? You can make a short-dated bet where, by the end of the week, you think a stock is going to go up or down a certain amount. Or you could do a month or a year. So everything with options trading from the strike price to the expiration date is completely customizable. So options are fully customizable, the strike price, right? Where you can buy or sell a particular stock, as well as the expiration date. And this is probably pretty obvious, but longer dated options are more expensive than shorter dated options. Because let's say, for example, going back to that Apple example, it's currently trading at $258, and I buy an option with a $290 strike price. I buy two options, actually. One with a 1 week expiration, one with a 1 month expiration. Well, let's say the entire week goes by and Apple goes up a little, but not up to 290. My 1 week option is completely worthless. It is worth $0, whereas my 1 month option still has some value, right? If the second week Apple rips up to $300, it's now worth some money. So more time is better. Another thing I wanted to mention is when you are buying options, you don't have a ton of risk, right? You of course can lose money, don't get me wrong. Most retail traders in their Fidelity and E-Trade account, they lose money trading options. However, you don't have that much downside. Your only downside is the premium. The premium is how much you pay for the option. So if I buy a call, which again is the right to buy a stock at a particular price within a particular amount of time, or a put, which is the right to sell a stock at a particular price within a particular amount of time, my max downside is the premium, what I paid for it. If I buy an Apple call option for $4 and Apple goes down, it doesn't go up, it just stays flat or goes down, I just lose the $4 that I paid for the option. However, if you are selling options, it is incredibly, incredibly risky, right? Because you have uncapped, if you sell a call option, you have uncapped downside. I'll give you a simple example is let's say 5 years ago, you sold a call option on NVIDIA. You said, I don't think NVIDIA is doing anything. They have a crazy CEO. He's worthless. And you sold a call option on NVIDIA with a 5-year expiration date. The stock is now up over, 1,200%. So you would be down a ton of money. So long story short, buying options, you can obviously lose money doing it and you really need to know what you're doing. However, selling options is incredibly risky because you have uncapped downside if you're selling call options. And then if you're selling put options, a stock could go to zero. So technically you don't have uncapped downside, but you still have a ton of potential downside if you are selling put options. So very briefly, I wanted to explain why do options exist, right? Because a lot of people think it's just gambling degenerates who are trading options. And of course, there are people who just want to gamble in financial markets, but options are a tool, right? So it really depends how you use them. So I'll give you a simple example is options are critical, and I learned this in my time as a quantitative trader at Susquehanna, is they're critical for protection, for downside protection, for hedging. So I'll give you, a simple example is take the country of Saudi Arabia. Most of their income, most of their money comes from one asset, oil. So maybe to kind of balance out how much money they're making in a year so they know how much money they can spend, they'll buy put options on oil. So if the price of oil falls drastically, it's not like Saudi Arabia's, revenue in a year falls by 50%. So they will buy put options on oil. So that's one example. Or a farmer maybe wants to hedge the price of corn. Maybe they'll, buy put options on corn. So if corn goes down a ton, it's not like they're losing half of their income. That is one example of why there's actually legitimate reasons why people use options. I'll give you another example is a lot of companies nowadays, they'll essentially pay people or bonus people in stock options, in stock calls. So for example, if you're Apple and you want to pay your CEO, you may say, hey, I'm not going to give you a bunch of Apple stock. I'm not just going to give you $25 million of Apple stock for free. What I'm going to give you is a bunch of Apple call options with strike prices of $290 and $300 and $310. So basically, you have to prove to us your incentive is to make the stock price go up. If you crush it and Apple crushes it and the stock goes way, way, way higher, you can make a ton of money, but you actually have to perform. So there's very legitimate reasons why options exist. And I think that's important to mention because there definitely is a lot of people who think it's just people who just want to degenerately gamble in financial markets, and that's not always the case. So when you're trading options, there's 3 important things for every option. There's the expiration date, the strike price, where can you buy or sell, and then the premium, which is how much are you paying. So I wanted to take you through some profit grabs. So here's what it looks like to buy a call, right? Your max downside, which is why you'll notice it's just a flat line, is the premium, is how much you pay for the call option. However, just because the price of the stock at expiration is greater than the strike price does not mean you made money. So I'll give you an example. Let's say the premium was $1. You buy a call option, you're paying $1 per option, and the strike price is $10. So you need the price of the stock to be above $10 at expiration, to be above the strike price, to be essentially in the money. But let's say that stock ends at expiration date at 10.50. Well, you lost $1 in premium, but your option is worth 50 cents, right? You can buy the stock at $10 when it's trading in the market at 10.50, so it's worth 50 cents. You can buy the stock at 10, sell it at 10.50 in the market, but you still lost 50 cents. So your break-even point would be $11, right? Because then you made $1 on your option, but you lost $1 in premium. So $11 would be your break-even point. And then from $11 onwards, you basically have unlimited upside. And then here you can see a profit graph for a put. And again, if you guys want more videos on trading strategies, options trading, I'm happy to do one. This is just kind of a beginner tutorial, so I'm not really covering everything I learned at SIG, all the complex math, but I did want to go through something called time decay, which is really important with options. Is if you buy an option, every second that goes by, every day that goes by, where the stock price is unchanged, your option is losing value, right? You are constantly losing value due to time decay, right? When you buy an option, you need the price of the stock to go up if it's a call option, or go down if it's a put option. So every day that nothing is happening, the value of your option, if you try to sell it a day later, your option is going to be worthless if the stock price didn't change, because one day went by and nothing changed, right? And options are all about time value. You're hoping for the stock price to do something crazy, either go up a lot if you're buying a call, or go down a lot if you're buying a put, within a certain amount of time. So you have time decay, which is a bad thing when you're buying options. You don't want days to go by where the stock price doesn't change. So this is called time decay, or theta. The next thing is implied volatility. So let's say, for example, because this is really interesting to think about, is you could still have time go by, but the price of your option increases. You'll still lose money due to theta, due to time decay, but the price of your option could still increase even if the price of the underlying asset, the stock, hasn't changed. So let me give you a simple example. Let's say I buy a 1-week call for Apple. I think the price is going to go crazy. It's going to go up a lot. And nothing happens the first day. The price of Apple is still $258 at the end of the next day, so I've lost a day. The price hasn't changed, but Apple announces we have some huge news coming, right? So they don't say anything else. They don't say if it's good news or bad news, so the price of the stock is the same. However, the implied volatility, the probability of the stock changing prices vastly within the upcoming few days, shoots up. So the price of your option may actually go up if you try to sell it the next day. Even though a day went by, the price didn't change, you had this news announcement, this is called implied volatility, that, hey, we have this big announcement coming. And obviously, if that announcement is, we're launching a new product and it's going to revolutionize the world, the stock price may surge and your option may be worth tons and tons of money. So that is called implied volatility. So long story short, when you're trading options, there's all these different things like time decay, implied volatility that I could make full YouTube tutorials on and get much deeper into, but I'm just trying to explain them in basically a beginner way. But the next thing I wanted to explain is kind of the difference between buying and selling options. Because I said this earlier, but buying options, your downside is fixed. You can still lose money, but you know what you're paying. You're paying the premium, and that's your max downside. However, when you're selling options, especially call options, you have unlimited downside. So really, you should probably only be, if you're a retail trader, you should really only be selling options if it's a covered call. So what a covered call means is you're selling options on a stock you own. So in the example of NVIDIA from earlier, where NVIDIA's up like 1,200% within 5 years, if you just sold that call option, you are down so much money, right? And you have to go pay that for selling a call option. However, if you own NVIDIA stock, you don't actually own any cash. All you have to do is, again, the person who bought the option has the right to buy the stock at a particular price. All you have to do is give up your NVIDIA at a very cheap price, which of course still isn't a good thing because NVIDIA is worth a ton more money now than it was 5 years ago, but you're not actually at the risk of like having to spend a ton more money. This is called covered calls. You're just giving up a stock you already own. So there's actually a lot of people who own stocks who will sell call options, and it's not a super risky strategy because if the stock rips way higher, all they have to do is give up the stock they own. They have to sell it at a price that is worse than they could get in the market. So why do people do covered calls? Why do people want to sell call options on a stock they own? You know, maybe they think it's a good way to make some additional income every single month. They don't think the price of the stock is going to change that massively, so they're just selling volatility. They're just selling call options, and then, worst case scenario, the stock rips way higher. They have to give up their stock at a below market rate price. But it's not a very risky strategy. Usually, the only people who should be selling options outright are real professionals, trading firms like Susquehanna, Citadel, because it's an extremely risky strategy. So obviously this video is meant for beginners. If you guys want more trading strategy videos, please let me know ideas in the comments. I'm very happy to make more videos about quantitative trading, my time at SIG. But what I wanted to explain very briefly is how you can put together some very interesting strategies with options. You don't necessarily just have to buy a call or buy a put. For example, we discussed covered calls, which are when you own the underlying stock as an investor, but you're willing to say, and it's not super risky because you own the underlying asset, and you're willing to say, yep, I'm willing to give up the extreme upside. If the stock rips 20% higher, that's fine. I'm willing to give up the upside by selling call options to get in some extra income every month, right? So that's called a covered call strategy. And there's other trading strategies we can discuss with options. For example, there's a straddle. So a straddle is when you buy both a call and a put. So you're basically saying, I don't know what's going to happen to this company or this stock, but I think something crazy is going to happen, right? So for example, if there's tensions in the Middle East, it's not uncommon for people to buy calls and puts on, let's say, the price of oil. The price could tank, the price could go way up if there's a shortage. We don't know what's going to happen, but we think something crazy is going to happen in commodity markets to the price of oil. So you're basically just getting exposure to volatility. The way you lose when you buy a straddle is if the stock price doesn't move much. It stays within a narrow range. When you're buying a straddle, you want the stock to or the commodity to either go up big or go down big. You're betting on volatility. There's other trading strategies we could discuss, like a bull call. There's all these different trading strategies we could discuss, which is when you buy one call option, but then you sell a call option with a higher strike price. So there's all these different strategies you can put together. But regardless, the point of this video was meant to be for beginners. So I hope you enjoyed it. Please comment any questions, as well as letting me know other video ideas. And thank you so much for your time. I hope you learned something about trading in this video.